Patu from FreeFinCal, and in this video, let's discuss ICICI Prudential India Opportunities Fund. This is an open-ended fund, and its NFO period, or the new fund offer period, is set to open. The window is set to open on December 26, 2018, and will be on up to January 9th, 2018, and after that, it will be available for continuous purchase and redemption. So this is what you're seeing is a draft of an article that I've just written. It will be published tomorrow. Now, this is a thematic fund, or on what it calls itself as a special situation fund. This essentially has higher risk than a diversified equity fund, and let me explain why you should avoid this fund, and or at the very least wait and watch for it perform and then take a call. So investors, before deciding on any mutual fund, should either read the scheme information document, or the SID, or they can read the key information memorandum, or the KIM, which is a shorter version of the SID. So the objective, it says, is to generate long-term capital appreciation by investing in opportunities presented by special situations such as corporate restructuring, government policy, and/or regulatory changes, companies going through temporary unique challenges, and other similar instances. It can invest anywhere between 80 to 100%, not 110%. Wow, that's a typo. In special situations equity, the rest can be in normal equity, mutual funds, bonds. It can even invest in derivatives up to 50%, or arbitrage opportunities, and also in international equity and bonds. So it says that the scheme will follow a blend of value and growth style investing. So value stocks are those that are available at a price which is lower than the intrinsic value and have high dividend yield. Growth stocks essentially do not have high dividend yield and have growth potential. So and the fund will follow what is known as the bottom-up approach, which means that you will look at the individual stocks and not the sectors first, and so on. Now, so the question is, what do they actually mean by the special situations? So to understand this, there's not much information about special situations either in the scheme document or the KIM. So I was searching for the presentation that usually is handed out to sales guys and relationship managers. This is not available to small investors like you and me. So this presentation, somebody had uploaded this on YouTube just a few days ago. So I've linked that presentation here. I've also linked it in the article. I've linked it in the description box below. So let me go through that. So it says, according to that presentation, it says a special situation is a unique situation that companies may face from time to time, and these are opportunities to a fund manager who can foresee and interpret the implications of that opportunity. Now that means there's too much onus on the fund manager to actually get it right, to get that interpretation right, and they could get it wrong. So that's why I keep saying that this fund is a high risk fund compared to any diversified fund, and if they get it wrong, then the investors will suffer. Of course, the fund house will only show examples, as I will talk about below, of examples where they have got it right. They will never talk about things when they got it wrong. So the presentation also talks about different kinds of special situations due to a temporary crisis in a company, regulatory changes, management changes, change in the industry, or higher competition, or unfavorable business cycles, etc. And they've shown examples. They've shown examples of an MNC buying a stake in United Spirits and the stock moving up. Infosys undergoing management change, so the stock dipped and then it went up. Then there was a strike in Maruti Suzuki plant in July 2012, and the stock fell and then it moved up. The more popular example is the Maggi lead controversy, lead content in Maggi, supposed lead content in Maggi, and its impact on Nestle price. But then it moved up when the ban was overturned. Then there could be a temporary crisis in an industry or sector due to a new entrant, for example, Jio in the telecom sector, increased competition, and then a domino effect where one fails and then everybody else fails. Then there can be macroeconomic changes, government pressure, or global pressures. And one example they show is the correlation between weak rupee and the increase in stock price of IT companies and export companies. So there can also be a special situation in the economy macro changes in macroeconomic indicators like inflation, fiscal deficit, oil price, etc. The fall in crude oil prices over the last few years have resulted in an upward movement of stocks that operate across sectors, and they show, you can see that in the presentation, how the paint companies have benefited from this. Then there can be special situation due to government action or regulatory changes, policy changes, tax changes, etc. And they show the example of demonetization on financial services stocks. Of course, when the point to remember is when the demonetization occurred, it's impossible for anybody to predict how which sectors will be affected and which sectors will not be affected or affected favorably. That's the hunch. So the fund manager is essentially going to take a call, and they're going to it's a guesstimate at best, and that's the risk in this fund. And people who are interested should understand this. There can also be special situations like how the slowdown in the Chinese economy, special situation due to global events such as the slowdown in the Chinese economy affecting our metal and commodity stocks, and their subsequent increase. Now, this is a key point. Now, the fund wants to project itself as an alpha generator by trying to unearth such special situations well in advance, so that they can generate the necessary gain. Now, the point is, it also says the following are the attributes to manage such a fund: willing to dispute conventional wisdom, which means often buying a falling stock, invest in stocks that have a negative correlation with an economy, that is, stocks which will do well during recessions and not so well during economic boom, find winners in negatively impacted sectors, and the fund manager should also have conviction and focus on long-term objectives. Now, these are not just the attributes of fund manager. These are attributes of the investor who wants to hold this fund too. So, which means that the investor should be patient and should have the risk appetite to withstand the ups and downs. So it's a clearly guaranteed high volatility with potential high reward kind of instrument, and most investors do not have the attributes to invest in this kind of a fund. They do not have the patience. So I would strongly suggest avoid. They also say, this is very interesting, the fund house says they have experience in special situation investing because they have increased exposure to ITC in May 2017 when it fell, and then it moved up. This was for ICICI Dynamic Fund, now called the multi-asset fund. Then they increased exposure in Infosys when it underwent the management issues. ICICI Balanced Fund, now called Equity and Debt Fund, did this. They increased exposure and then it moved up. So that's the special situation investing. These are proven examples. There's no problem there. My problem is that Shankar Narayan, who is one of the fund managers here, of course he's a star, so you have to rope him in for this kind of fund to get the AUM. There's no problem about his ability. He is one of the best fund managers in the world. There cannot be any dispute on that. But why do you want to buy a fund exclusively for spotting special situations? If the fund house is doing this in many of their funds and they have a small exposure to such special situation stocks, investors can enjoy that benefit without the associated volatility of an exclusive fund for special situations. I think that's good enough for everybody. That's my problem. Also, the examples shown are all cherry-picked ones, and that were ones that have worked. That's clearly hindsight bias. They could get it wrong, and nobody will talk about examples when things went wrong. Especially when you want to sell a fund, why would they want to do it? So, investors who are interested in this kind of fund should recognize the risks, such risks, and my advice is avoid it. There are other good funds from ICICI. You can choose them, or if you're interested, then wait and watch the volatility. Don't look at the returns. Watch the volatility for a couple of years. It's an open-ended fund. You can invest at any time. Then you can take a small exposure. If you take too much exposure in your portfolio, it will affect returns. Since you're only going to take a small exposure, you might as well not take any exposure at all. So that is the reason why I am against this idea of exclusively buying a fund for investing in special situation stocks. So I'll catch you again in another video. So I'll link this post after it's published. The presentation I've talked about is linked in the description box. I'll catch you in another video. Bye bye.